Okay, so I kind of start with the big picture as usual. We're got the same situation, which is, the markets are being pumped up heavily by stimulus. Fed QE stimulus is continuing to go to new all-time highs. And then one of the mechanisms that usually helps transfer that money from banks, from the Fed to the bank to the market, is buybacks, cheap interest rates. And corporations don't want to expand production because aggregate demand is not expanding because there's too much debt in the system already. And so what they do is they borrow that cheap money and they fund buybacks and mergers. And we can see that same situation that developed during the GFC already. We're getting record highs in buybacks. So that same mechanism is leading that most of that money to go into stocks and asset markets, which is likely to continue. Right now, the sort of the outlook of Wall Street, this is JP Morgan report, and it basically looks for tapering to start in January, just pretty much in line with the consensus. And that would mean something like September, October, November, we get serious taper talk. And remember that you usually get a decent, even major shock in the market when they actually start talking taper, just like we did April 2010. So we have to be watching out for that. And we've kind of had what I would say is we've kind of had a Goldilocks NFP report on Friday where it was pretty good, showed the recovery is strong, but unemployment's still going up. The wages were mixed in terms of wages up, but hours were down. And so a lot of the things that the Fed would really look for to say, yes, this is really, showing that we're really recapturing these millions of jobs that were lost is starting to develop. And we probably need a few of those. I don't think we've had one. So we may get a Goldilocks period for a little bit longer that prolongs this, or we could start to see catch up that actually shortens that. And that's really what the market is really focused on for the narrative. Lockdown keeps easing globally. There's some hiccups, some resurgent new strains and things, but essentially the lockdowns continue to ease and the recovery continues to go. And since we had the deepest recession since the Great Depression, in 2020, we've got a huge catch up to go. So it's going to be a very strong growth period in H2, but realize after we get through that sort of catch up and recovery of a lot of that, we've got this trend that is likely to continue. And that is during basically every single recovery, we have lower and lower growth because debt is getting higher and higher. So that's likely to, so at some point, 2022, 2023, the story is going to likely be that the growth just isn't reaching target levels. All right, and this is sort of inverted Fed balance sheet. And you just want to see this as sort of your rate of debasement indicator to realize that you want to try to keep up with in your investments and in your purchasing power. And then also realize who gets the lion's share of those is the top percentile, the people who own the assets. Again, velocity keeps lower velocity because there's too much debt, keeps that inflation in the money supply sort of trapped in financial asset prices. And so they have outsized gains because of that are likely to continue. All right, but we're getting a kind of an environment where you want to be a lot less aggressive and you want to be a little bit concerned and you want to watch developments closely. We've had divergences in two of the major internals. This is nice cumulative net volume, and this is our XVG is the geometric value line we use as our points gained indicator, and both of those have been divergent since early mid-June. And then we've had the net new highs that's divergent for now 7 weeks. And that's getting to the point where you're starting to get a concern if you get a correction, it could become a more major correction. Now, If we continue to run here, we could unwind these. These could make new highs, and that would unwind that. But if we keep going and these divergences obtain, it means we're building sooner for a big correction that we will want to protect against. And we can see now with our supply and demand indicators, they did go to a positive mode for a very short period of time, but they're not. They're all negative again. In other words, the supply is above its moving average, the demand is below its moving average, and the spread of the two is below both of its moving averages. We want those to change. You really need to see demand going through this 1340 level, supply falling back down below this 878 level, and the spread rising above this 461.50. We get all those things, then we start to look to see if this rally can expand or extend. Otherwise, we're in kind of a risky period. And what we kind of are seeing is that techs are trying to lead the market higher, but it's a very narrow rally so far. So let's see if the techs can continue. We've got Amazon and Apple that are on the edge of breakouts. If those breakouts can develop and then it can spread to IWM, which is a Russell, that's the real thing we need. We need small caps and even mid caps to break out and start participating in this rally for it to extend in a sort of reliable, safe way to participate in. And then really it would be also if we can get IWM breaking out, really watch the IBD 50 FFTY, see if we can break above this triangle and start to see improved relative strength. Right now, we have this downtrend in relative strength. This is a relative strength for the S&P on a point and figure chart, and we're down both short term and intermediate term. And those tend to be the times when our lists don't outperform nearly as much as they normally do. So we don't have as skewed a return to risk ratio from a lot of our strategies like this to turn around if we get an extension in the market for it to be a better environment and better reward risk. And then, just realize we're at this point in time. So here's our recovery compared to the last three. And you can see that we're in this period where sort of, 1 year to 1.5 years after the low, after the recovery starts, you're getting into this sort of choppy period. You often get a growth slowdown that economists kind of liken to when you're in an airplane. You start to take off and then you get up there and then they kind of slow down and you can feel the plane almost dropping and then it finally catches hold. That's often the case with recovery. You get sort of a growth slowdown. And when you get that, you get a lot of chop, you get a lot of shifting of leadership, and you get a lot of sideways action in the major averages. And you can see this is sort of the presidential cycle pattern that gives you an idea seasonally. Sometime between mid-July, mid-August, you often get peaks in this year after the election. So all these things are kind of lining up to tell you that we're getting a riskier environment and we have to kind of be careful. We do have in this recovery a lot more of a gap to catch up for because the recession was so deep because of those lockdowns. So we could prolong this period, but sometime in here, we're really going to be watching it. If these divergences continue to build, the internals will also be confirming it as a riskier backdrop. Realize that, go to the next slide here, that we're sort of, you get July is usually okay, but August and September are the worst 2 months. However, usually when you get the first 6 months over 12.5%, you have a good second half. It's not great. It's not nearly as good as the first half, but it's usually up in that half. So you get some volatility off of a July, August period, and maybe even a decline into September, October. But that fourth quarter usually makes up for it, and you have a decent end of the year. All right, and this is just probably one of the clearest indications of the narrowing rally. You like it when a rally has strong breadth and more participation, and we really have the opposite of that. The S&P is making new highs, but underneath the percent of stocks above their 50 DMA, which is kind of an intermediate term, uptrend indicator, these are continuing to deteriorate even as we're making new highs, and we're getting close to this 50% level that usually when we get below that, it leads to a substantial correction. So we want to be careful about the rally broadening and not narrowing any further. All right, let's move to interest rates real quick, and we'll come back to some of our favorite stocks and sectors. So the interest rates have been backing. So we talked about earlier in the year, the interest rates were getting up to this level where we said somewhere in here they're going to back off. The inflation expectations usually kind of peak and come off. We talked about how there's going to be a peak in the inflation from comparisons with the really weak last year. The Fed's done a very good job of preparing the market for a sort of a temporary phenomenon, and interest rates have backed off, and the recovery has not been as robust as a lot of people really expected. So all those things are leading to a back off in interest rates, but now we're starting getting to some support levels. And so whether this 1.314, whether that can kind of hold and we start to kind of play around and base for an eventual move higher, or whether we get more of a slowdown than expected and we start to go lower, that's going to be an important part of what develops in the second half. Generally, we get this sort of spike in the gap between actual yields and inflation expectations and break-even rates. And so what generally happens is those widen for a while, they get to a certain level, and then it takes about a year for them to narrow. And the way they narrow is both for the inflation expectations to come down and for the rates to begin to move back higher. So where we maybe are at the sort of this first peak here, we may have one more peak to go there or not, but eventually we're going to get to this phase where rates start moving up again likely and inflation expectations start coming off the board. Our top bond themes then are so corporate high yield is probably our best. We like TIPS, we like convertibles, we like mortgages. All those things are things that are not going to get too hurt by a mildly rising interest rate backdrop. And we look for rates to start to head higher at some point in H2. In terms of our ETF's top relative strength sectors, it hasn't changed a lot. We basically, the new highs that have just recently broken out, 10, which is a base metal theme that we've had for a long time. Software and Internet of Things. So that's the tech leadership that's trying to take off now. Those are the top groups, and internets and software have very good breadth behind them if you look at the members of the group. So those are kind of current leaders. And then you got a really big list of ETFs that are still basing small caps, retail, steel, uranium, lithium, Bitcoin and blockchain, leisure, some of the cars and electric cars, and some of the financials and media. These are things that you can look for to see if they can follow and break out themselves that could be good plays as they break out.